All right. Good afternoon, everyone. Let's go ahead and get started. Happy Earth Day. My name is Lee Reiners, and I'm the Executive Director of the Global Financial Market Center here at Duke Law. Thank you for attending today's panel conversation on the future of financial regulation under the Biden administration. And I am very fortunate to be joined by several of my talented colleagues today. In the interest of time, I will forgo a full introduction for each of them, but I am sure they are familiar to most of you. But they are Professors Sarah Bloom Raskin, Elisabeth de Fontenay, Jim Cox, Lawrence Baxter, and we might be joined by Gina-Gail Fletcher in a little bit. Financial services regulatory reform promises to be very active these next 3+ years, with the Biden administration focused on activity at the intersection of financial regulation and social policy. So today's panelists will provide context and summarize current and expected developments across a range of key regulatory areas, agencies, and actors. Of course, financial regulators have always had to respond to current and ongoing market developments, and that is certainly the case now. So today we will also touch on the regulatory response to the GameStop saga and the emergence of SPACs. The pace and tenor of financial regulatory reform will also be heavily influenced by the leadership at the federal prudential and market regulators. As they say, personnel is policy. Well, several key appointments have been confirmed by the Senate, including last week's confirmation of SEC Chairman Gary Gensler. We are still waiting for nominees to be the next comptroller of the currency and chair of the Commodity Futures Trading Commission. In addition, President Biden's nominee to be the next Consumer Financial Protection Bureau Director, Rohit Chopra, awaits Senate confirmation. Given these vacancies, the speed and substance of reform is still uncertain. So in terms of format, we will reserve the last 15 minutes to take your questions, which you can submit via the chat function. Today's event is also being recorded, and it will be made available on YouTube and the Global Financial Market Center's podcast. I also want to remind everyone that a week from now, we'll be hosting another virtual event on the collapse of the family office Archegos Capital Management. That event will be moderated by the center's faculty director, Lawrence Baxter, and you can find more details on our website. So with that, let's jump into today's panel. Sarah, I would like to start with you. And so before we look ahead, I actually want to have you look backwards and put in perspective what financial regulation was like, what the Trump administration's approach was to financial regulation these past 4 years.
Great. Well, thanks, Lee, and thank you, everybody. This is a great set of topics for us to be launching into today. And I'll start really with Lee's question and take us sort of do a little trip down memory lane here. Okay, so one thing that was really characteristic of the Trump administration's approach to financial regulation was, and many people will recall this, a repeal of Dodd-Frank. So you'll recall that after the financial crisis, Dodd-Frank was put in place, which consisted of a host of financial regulatory reforms. This was a very contentious, actually, set of reforms. And one of the really first out of the box approaches of the Trump administration was to do whatever possible to repeal or weaken it. So there were several attempts in the House and in the Senate to actually attempt to repeal particular provisions. So you saw attempts to repeal. When repeal efforts themselves didn't get overwhelming support, you started to see real assaults on enforcement of different provisions. So a sense that different provisions, okay, they're on the statutes, they're in the books, they're in the regulations, but they won't be enforced. And you saw this in various ways. You saw a watering down of a lot of the regulatory actions that were supposed to be influencing, we're supposed to be enacting the statutory requirements. And you saw a lack of funding, right? So there was, and this is real behind the scenes stuff, but you saw for those financial regulatory agencies that rely on appropriations, you saw a real squeezing of their budgets in such a way that their ability to enforce was weakened. So that's really, sort of the range of approaches that the last administration took to financial regulation. More specifically, you saw in the FSOC, and the FSOC, as many will recall, is the device that brings together the heads of all of the agencies in a coordinated way. So this was the one mechanism, we have such a disparate regulatory system, but the FSOC was the tool in Dodd-Frank to bring the different agencies together. You saw a weakened FSOC. And when I say weakened, I say that from the perspective of particular attempts to take away the sole authority that the FSOC had. And that sole authority had to do with designation of entities for enhanced prudential supervision. So the FSOC has the ability to name institutions that should be subject to enhanced prudential supervision because they provide more systemic threat. So that designation authority was weakened by the FSOC in the last administration. There was a move towards what's called activity-based designation, where the focus was on the activities rather than on particular entities. More generally, from a macro perspective, what we saw was a view of regulation, of financial regulation, that is not preventative, but is very much after the fact, right? So the philosophy of regulation of the last administration was one in which you wait for a meltdown, a complete and total meltdown, and then you act. It's not a regulatory view where you attempt to be an early warning or where you attempt to put in particular thresholds that accelerate the interventions of regulators. Instead, it was a hands-off approach. We will let markets do what they're going to do, let the economy do what it's going to do, and then step in if there's a meltdown. And of course, we had a meltdown, right? We had the pandemic. And essentially, one of the big, sort of the philosophy of the regulatory apparatus was in full throttle once we saw the pandemic. The last thing I would say, Lee, to your question as we kind of go down memory lane here, is the financial regulators historically have tried to understand risk and understand risks as risks. What this last administration did was it viewed many risks from the prism of a political question. So, for example, climate, okay? Climate change presents financial costs. It is a risk, okay? The last administration didn't view it from a risk prism. The last administration viewed it as a political issue. And so for that reason, that has certain consequences, the primary one being that nothing was done to actually advance the risk prevention that is necessary in this one area of important risks. So I think the philosophy of the last administration is one where financial stability is less. Risks aren't viewed as a financial stability issue; they're viewed as political, and I think that's problematic. But let me stop there. That's kind of my sense of what the last 4 years looked like from a financial regulatory perspective.
Well, that was very helpful. Thank you, Sarah. And now I want to get your thoughts on sort of the next 4 years or 3+ years at this point. Reflecting on the most recent presidential campaign, I don't recall financial regulation to be much of a focal point, from either candidate's standpoint, which is different than certainly what we've seen for the previous, 3 election cycles, right? Obviously, 2008 with Obama versus McCain. But was there anything that then candidate Biden was saying that sort of would foreshadow some changes we might be seeing these next 3 years?
I think you're certainly right in your observation, Lee, that that financial regulation did not take center stage in certainly in the presidential debates. I think that doesn't mean that it's not important. I mean, we obviously know that Joe Biden was very supportive of Dodd-Frank. He was vice president during the financial crisis. He understood very well the importance of that statute and the importance of the reforms that were necessary to actually ameliorate the possibility of another financial meltdown of that nature. So I think that it was very much a set of background issues going in. It didn't need to be explicit, but we know that he and and his team are very supportive of the need for a strong financial regulatory and financial system. So I think that the importance of that architecture is a baseline assumption that he goes in with, and I think that is important, and that really bodes, I would argue, bodes well for how we move forward in thinking about financial stability as new risks emerge.
Thank you, Sarah. And Jim Cox, I want to bring you into the mix now, because as I said earlier, personnel is policy. And as of this week, there's a new chairman at the Securities and Exchange Commission, Gary Gensler, and he's a familiar name. So, Gary Gensler, for those who aren't familiar, was chairman of the Commodity Futures Trading Commission for a number of years under President Obama. So, Jim, what does Gensler's past at the CFTC foretell in terms of his priorities and how he might run the SEC?
Well, I think the idea would be that, given his background as a trader, somebody who came out of the markets section, that he would be more interested in market-oriented areas. And certainly there's a whole bunch of those. And I was just at a board meeting the other day, an organization that concerns about markets and thinks that, well, this is our time, this is our issue. And I don't disagree with that's an issue and that's something natural to him. There's no history at the SEC of a chairman coming in and implementing an agenda. And I think that that's going to be true for this case, that they tend to be dominated by events, forces that are well beyond their control. So, and it's very hard to get very many things started. And I think we also going to find out that things are largely going to be incremental. So just picking up on a little bit of what Sarah's theme was, which is that wasn't necessarily hands off during the prior 4 years at the SEC. That's not how I would say it. It was deregulation off, and did this in lots of different ways. And if you thought about whose thumb was on the scale, I think you could say there were two thumbs on the scale. One, the people in the markets who were buying things never got listened to. So their representatives, including the Investment Institute, never got listened to. It was the sell side, and which is another word for like Wall Street, the investment bankers, people who create the products, and the people who manage the products. And the other thumb on the scale were the managerial class. So left out of that process are what we would think for the people who actually own these companies, the Council of Institutional Investors, various investor groups, et cetera. And so the buy side has been felt that they've been short-term. So it's pretty easy to think that there's a force out there to think that what we want to do is right-size a lot of what happened in the prior 4 years. And some very easy areas of that are we ought to change what happened with mutual fund regulation in 2014 that virtually took the funds out of the commercial paper market, restored them back to the banks, of a thumb on the scale for the banks, I think. We ought to change the rules on proxy advisors and also shareholder proposals, okay? And it gives some real thought to why we keep liberalizing with the forces of inflation, the criteria for who's an accredited investor. You can imagine all those things, but I don't think those are going to happen, okay? I think the real events are going to take over. We could also think about going big, okay, swinging for the fences. Let me give you two big fences. Why the hell is it in today's environment that suddenly we think that the role of the securities law should be limited to just focusing on people who own the company, investors? And that horse is already out of the barn. And we started finding that NASDAQ's going to require in another year certain diversity requirements for listing on the board. We know that California has a statute along those same lines. We're all talking about climate change, right? But these are all things aimed at companies, quote, public, as defined in the 1930s. And we seem to be having a culture that wants to define it somewhat differently. So that'll be swinging for the fences there, just redefining that, okay? And, if you ask me what keeps me awake at night, it's the same thing that kept me awake two years ago. And there's just way too much leverage in markets and all kinds of financial products, exchange traded funds. And we have Ryan Clements here, could go on ad nauseum about that. And there's way too much leverage there. We're too much leverage in the retail. I mean, we're gonna have this program in a week from now. That's what's too much leverage. All of that happened because of a damned lack of transparency, which you would think would be heart and soul of the securities law. So that's not happening. So what's going to happen is chairmen get overtaken by events. They have a somewhat unmanageable staff, even with their own directors. So it's going to be somewhat piecemeal. So let me just, do I have time to 3 minutes to go and talk about just a couple of things that may happen or not?
I could never say no to you, Jim.
Well, you should say no. I'm not. Okay. Well, Elizabeth's going to talk later about SPACs, but we're already seeing what happens there. You get the right people in, and you reach the fact that one way we'll put the brakes or maybe slow down SPACs is just accounting interpretation. That suddenly these warrants are going to be treated as debt and not as equity. And that's what's really killing the investors who stick around for these damn SPACs and see what that does. So you're going to have some tweaking that's going on there. I think a big change would be the accounting profession really needs to be cleaned up again. Here we are, 20 years later, after the dot-com bubble, we learned all kinds of lessons there. We put them in Sarbanes-Oxley, and we've gone through a lot of those red lights. Somebody's got to now start enforcing the law. And so that means changing who's the board chair of the PCAOB. I mean, one thing that happened last time was you totally deregulated the accounting profession by just changing the board chair of the PCAOB who regulates auditors, and then just put it on pause. And so that's an easy change, okay? Get somebody in who cares about things. Sustainability. We're going to have sustainability disclosure, and that's being battled right now. The problem with that is that it's going to affect about 50% of the productive assets in America. It's not going to get to the hedge funds, the private equity funds, et cetera, who are probably, so where are all the fossil fuel assets going? They're all going dark. The oil companies are unloading them into hedge funds, okay, entering into private contracts with them. And so we're going to have all kinds of disclosure aimed at fossil fuels, et cetera, that will not have any effect as long as we still have this public-private divide that we have right now. So there's lots of interesting issues out there, but I'm betting there's going to be a piecemeal agenda. It'll be a progressive agenda, and I do think there's going to be a lot more listening to the buy-side folks than the sell-side people in the past. And let's just hope the system doesn't blow up in the interim.
So, Jim, you mentioned that the SEC is driven by events more than anything else. And of course, there's sort of been one event of the last couple of months that's taken up all the oxygen in the room, and that is, of course, GameStop. And Elisabeth moderated a fantastic panel on GameStop a few months ago. Everyone can go to our website and check that out if they want to learn more. But, of course, this was a focus of Gary Gensler's confirmation hearings, Jim. So what is the SEC specifically looking into now as it pertains to GameStop? And do you expect them to take any actions to prevent a similar occurrence from happening in the future in regards to, either meme stocks or retail brokers like Robinhood?
I don't have any inside information about what they're specifically looking at, but the logical things is the whole leverage question that went into that. And that is the leverage that was provided by the financial product that were being used. It wasn't just buying shares, but it was buying options in the retail trade. And for some time, I think that's, I think like giving leverage to a day trader, with what we used to call them, is like giving a loaded revolver to a 4-year-old. Okay, I think it's a bad idea. And but certainly Robinhood's game plan, their business plan, is all built upon that. So looking at the phenomena of the retailization of capital markets, you've got to start with the idea that you really think the capital market should be available for everybody. Is this an American freedom, like not wearing a mask? Okay. And I would think that it's probably not an American freedom. It shouldn't be. And GameStop is a clear example of that. And the other thing you say, well, so they just slit their own throat. They bought stock and they wrote it up, and then they lost a lot of money, et cetera, like that. That retail traders were. We were very lucky. What would happen if Robinhood had not gotten the infusion of several hundreds of millions of dollars? Okay, what would have happened there? I think it would have really shaken up. We care about our markets, and we ought to care about the solvency of the brokers, and brokers ought to be responsible for their customers, quite frankly.
Elisabeth de Fontenay, I want to come to you. And Jim mentioned SPACs. These are special purpose acquisition companies. They've been in the news quite a bit lately, but I imagine some folks in our audience might not be all that familiar with them. So for edification's sake, can you just describe what they are, why they've become so popular? Is just sort of a sign of the times, the everything bubble, as they say? And then what are the risks to investors, and how might the SEC address these risks?
Great. So talking about SPACs, I could probably take an hour to do this, actually. So I will try to simplify as much as I can a product that's actually fairly complex. My short answer to what they are is they are a sign that we are in a massive asset bubble. So I second everything that Jim said about there being too much leverage and just too much capital sloshing around right now. But I would say it's my view is it's not simply a disclosure problem. It's really about zero interest rates. This is what happens when you have zero interest rates for a long period of time. But so what is a SPAC? The way I would describe it is it's like a private equity fund, but that is open to retail investors and that can only acquire a single company, right? So let's talk about how SPACs are set up, and I think that clarifies things. Basically, some sponsor sets up a shell company, so it's got nothing in it, and that company goes public. That is to say, it takes in a bunch of capital from retail and institutional investors, and it gives them stock in return, and also warrants, as Jim mentioned. But we'll get to that if we have time. And then the money just sits there, and the SPAC tries to go out and find a company to acquire. Now, the way these are set up is that the SPAC typically has 2 years to go out and find a company to acquire. If it doesn't find a company to acquire within that 2-year period, then all of the money has to be returned to the investors. Okay. So let's say that the company, the SPAC does find a private company to acquire. What happens then is the two merge, and through that merger process, the formerly private company is now a public company. So it has kind of automatically become a public company without having gone through an IPO process. And then what's interesting is the company gets all the money that was sitting in the pool of capital, but usually actually that pool of capital through complicated series of events disappears right before the merger, and they have to actually raise more money right at the time of the merger. And then they get the stock in the company that is now public. All of the investors get stock in the company that is now public, but typically the sponsor takes about 20% of that stock. Okay, so facts about SPACs: they've raised $100 billion so far in 2021, with about 5 SPACs hitting the markets every business day, and so that's why the investment bankers are not sleeping, and you're hearing about it publicly, how miserable they are there because they're busy doing SPAC transactions. So what are the risks for investors? Well, there are many. The one is that there's big sort of adverse selection of targets, which is to say the sponsor has 2 years to go out and find a company. If they don't find a company, they have to return all the capital. And so if you factor in costs, the sponsor is going to lose a lot of money. And so when you get close to that 2-year timeline, they have every incentive to go and acquire any company at any price just to get the deal done. And so you're kind of set up in a way where you think the incentives are not aligned with finding the best possible companies. You may end up with a terrible company. The second is the risk is dilution. So these investors that put in capital initially, when the merger actually happens, you get a bunch of dilution through these additional securities that are issued at the beginning, which are called warrants. That you get even more dilution by virtue of the fact that the sponsor comes in and takes 20% of the equity. Okay, so in a normal private equity fund, the sponsor takes 20% of profits. Here we're not talking about we haven't gotten to profits yet. We're just talking about the capital itself. And so from an investor's perspective, again, the company really has to be a home run for this to make any economic sense from your perspective. And you have to not overpay for it. And then the last risk is that there's a lot of legal arbitrage going on here. Essentially what you have is an investment fund, like a mutual fund or an ETF, that's not regulated like an investment fund. And you have an IPO of a company, but it's not regulated at all like an IPO. So there's minimal disclosure, there's minimal regulation of anything that's going on in this relationship, and that poses some risks, clear risks for the investors. I will note also from the private company's perspective, people always describe SPACs as a much cheaper and faster way of going public. I agree with the faster part, completely disagree with the cheaper part. Actually, it turns out that the fees are quite high for engaging in a SPAC transaction, because you have the underwriting fee when the SPAC initially goes public. You have another underwriting fee when they do a PIPE transaction to raise more money. You have the sponsor promote, and so on and so on. At the end of the day, actually, more likely SPACs are more expensive than an IPO, but they are certainly faster.
And I know the SEC, I think, recently put out a bulletin on SPACs. So what are they looking into? I mean, what actions might they take to sort of address the risk that you just highlighted?
Sure. So, the thing that I've heard the most about is what Jim mentioned, the fact that they are requiring folks to change the treatment of the warrants that are issued. So again, when the SPAC first goes public, as this empty shell company, they issue stock to everybody, but they also issue a warrant, which is basically just an option to get more stock. And the SEC is coming in. John Coates, former law professor, so cheers for the law professor crowd. It put something out saying that these should actually be treated not as equity, but as debt. So that would change the disclosure. Now, to the extent that we think that what's going on here is a failure of disclosure, that investors are not appreciating the risks, then I think that will have a big impact. I'm not entirely convinced that that's true. I think there is just a lot of capital, too much capital out there, and people will potentially continue to invest until they really internalize what is a true fact about this market, which is that it is performing terribly. So they've sort of lost 25% in value since they were issued. These so far have been very poorly performing assets, which seems to confirm the view that there is a lot of adverse selection of targets with these companies that are being acquired.
And of course, now there's multiple SPAC ETFs, which is a real sign of the times there. But I want to go back in time to a little over a year ago to last March, when the pandemic really took hold here in the US. And once again, we saw a complete freezing up of the money market mutual fund market, which is something that we saw, of course, back in 2008. There were some reforms designed to prevent something similar from happening again, and obviously they didn't go far enough. So the Federal Reserve once again had to bail out certain money market mutual funds with the money market mutual fund liquidity facility, other short-term lending facilities. Is this something that you expect the SEC to make further reforms to the money market mutual fund industry? And if yes, what might they be?
Well, they're certainly going to have to look at it, since there was another run on money market funds. But what they're going to do is a bit more of an open question. They might even decide that their first approach to regulating this was not the right one. So again, unfortunately, I think I need to step back and explain for everybody what's going on here. So a money market mutual fund is basically an investment fund that is invested in incredibly safe debt instruments. So safe that they basically should always have the same value. And so money market funds, so they're really, really short-term debt instruments issued by the US government or by commercial paper issued by corporations, which is, again, really, really short-term debt. So it's supposed to be incredibly safe. And so money market funds promise that, for every dollar you put in, you're going to get back $1, essentially. And so the problem with that is that since investors can get in and out at any time, you get the risk of having a bank run. So with banks, the problem is always they don't actually have sitting in a vault all of the deposits that people put in. They go out and they make loans with it and things like that. And so if you sense a sign of trouble with the bank, people will come and try to redeem their money first so that they can actually get the cash that is sitting there, and everybody else will be stuck holding the bag, or not holding the bag, as the case may be. So with mutual funds, money market mutual funds, the same problem can occur, is that if you expect that if the mutual fund promises you that they'll give you back $1 for every share, and you're worried about whether that's the case, then you want to get out as quickly as possible. And so you can have these runs on mutual funds, money market mutual funds, and that's what happened in the 2008-2009 financial crisis, and then it happened again at the beginning of the pandemic. And part of the problem, I think, is that the SEC's initial approach to dealing with this was setting up sort of hurdles for investors to get their money out. And I think that may have actually exacerbated the problem in this case, that investors knew at some point these mutual funds might actually prevent us from redeeming, so we should get our money out right away to avoid that happening. So in terms of, I think the SEC is going to look at it, but it's not entirely clear whether they're going to further what they've already started or actually potentially consider paring back on their reforms.
And Jim mentioned the public-private market divide. Elizabeth, this has been an area that you've researched extensively, including the shrinking number of public companies and investment opportunities for retail investors. So what can the SEC do to ensure a healthy pipeline of companies going and remaining public?
The SEC can do a lot. It can really change pretty dramatically the approach to setting that public-private divide, though it might need help from Congress. I will say from the outset that I'm somewhat agnostic about where that divide should be. I don't think we actually know what the right number of public companies is, but we do know that the number of public companies has been shrinking pretty significantly over a 30 to 40 year period, and that the companies that remain are much older and much larger. And we also know that retail investors, for the most part, can only invest in public companies, in the public markets. And I think we also know that if we unleashed them in the private markets, they would do really badly, because you cannot be a passive investor in the private markets. And the more money you have, the better you will do in those markets. So that's not a good setup for retail investors. I think the big problem is that we have deregulated the private market. So you can raise as much capital as you want and remain a private company. And so the question of whether you go public or not, when you have all this capital sloshing around, the decision to go public really falls into the hands of the founders. And they really have all the bargaining power today. And the founders are signaling, I think, that they don't want to go public, that it's much more fun to be a private company. They can do whatever they want. There's not as much scrutiny. They're not subject to lawsuits all the time and hedge fund activists and so on. And that's not necessarily a good thing. And so because the founders' incentives might not be the best thing for the company and for the investors. So they could, the SEC could take a lot of different approaches. One would be to force companies to go public based on some size. That would be to some extent reverting us back to prior regulation. Another would be to try to lessen public company regulation and usher people in that way. Another would be to sort of set up gradations of regulation. That sort of the bigger you are, the more you're subject to regulation, the smaller companies, less regulation. These are all approaches that people have considered, but so far not much has been done. And you keep seeing this shrinking of the public markets, with notable recent exceptions because of the sort of frenzy in the markets currently. There's been a banner year for IPOs, driven in part a lot by SPACs as well.
Right. Thank you, Elizabeth. Lawrence Baxter, I want to bring you into the fold here. Today is Earth Day, which is fitting because you teach a course with Sarah on the impact of climate change on financial markets. Clearly, this has been an early focus of the Biden administration, and sort of an all-of-government approach to climate change. But why specifically is climate change relevant to financial regulation? And can you just summarize what financial regulators have started to do in this space? Lawrence, you're on mute.
Good. Thank you, Lee. Thanks for including me. As you say, it's Earth Day today, and there's a lot more excitement around the dangers and impending catastrophes that climate change is presenting. So not only are all the environmentalists, all the scientists energized about this, but the markets, the financial markets, are paying close attention, as are the regulators, for the simple reason that to achieve very long, very rapid stretch goals, the markets are where the money is. And the money is going to be what produces the incentives and the sanctions. to shape how climate change is addressed. So let me give you some examples. The Biden administration has just announced that it plans to cut greenhouse gas emissions by 50 to 52% by 2030. That is a huge goal. It has to be given because climate change is coming on much faster, and we've been asleep at the switch for a number of years for political reasons. But to get there is not going to be easy, even if you marshal the financial markets as a whole. So the financial markets consist not only of investors and traders and retail buyers and sellers of stock, but of course the regulators as well. The Federal Reserve System regulates essentially the big banks and big bank holding companies, and there are other regulators I'll mention in just a moment. They have an ability to influence the reaction of those who fund, for example, the fossil fuel industry. So various actions can be taken by regulators. For example, with the Fed, they can apply stress tests which make banks show how they will do as climate change presents greater and greater threats. They can also, and at this stage I'm speaking hypothetically, they can also focus on whether the banks are managing their risk properly. For example, if banks are lending a lot of money in areas that are highly likely to be faced by widespread flooding or damaging storms that stem from climate change. Another thing that regulators can do is look at the concentration of funding or lending. It's not only lending, but mostly lending by big banks. If, for example, there's a very heavy concentration in real estate in certain areas, the same kind of concern arises. Or there may be a heavy concentration in lending to energy companies and fossil fuel industries. And the question there is, what is the exposure? There are other technical things that I won't go into because we don't have time here, but they can apply various other techniques to shape how the financial markets react. The problem is that we don't have unity in the country and no unified record of the success of those widespread government-sponsored activities. They are very powerful, but they've often gone wrong. For example, everybody probably remembers Soliandra, I think it was, which was a solar energy fund that ended up losing the government over $500 million because there was a degree of misleading activity there, but it wasn't only misleading, it was just a failed enterprise. And that triggered political divisions in the country, deep skepticism about whether government agencies should be dabbling in this. There are other easy to illustrate examples of how this can go wrong. So let's say, for example, the regulators decide to place pressure on banks not to react, or rather not to fund certain types of investments. Let's say, I'll use one that's highly provocative, not to fund hydrogen fuel cell investment because electric and lithium batteries are going to take over. There's deep division in the motor industry about which is actually the best way to go. And in fact, just yesterday, Bosch, the German company that has made huge investments in electric and battery and energy as alternatives to traditional fuels, was very critical of government actions to that extent because, as their CEO pointed out, that has the effect of suppressing what may well be much better alternatives like hydrogen cell technology that is developing but may be starved of finance. Now, it may be that that government agencies get this right, but none of us have gotten it right yet. So the government agencies like the Fed and others that I'm about to mention are entering an absolute thicket of controversy. Having said that, one thing that the Fed and another agency, I think, Lee, you're going to raise, which is the Federal Oversight Council, one thing they do have a direct concern for is stability of both individual banks and the financial system. So they are on much firmer ground there. And the Federal Reserve System is actually, some of its economists have produced a paper that basically urges the banking regulators to pay attention to these risks that they believe are very real. So in reacting to danger, the bank regulators are on much firmer ground. In promoting alternatives, it gets much more tricky. What have the other agencies done? Well, we have the Commodity Futures Trading Commission and the SEC that Jim and Elisabeth talked about earlier, both market regulators, and the CFTC, the Commodity Futures Trading Commission, actually led the way ahead of all the other regulators as well, when Commissioner Benham, who's the acting chair at the moment, commissioned a subcommittee to look into climate change. Commodity Futures Trading Commission regulates derivatives activities in the form of exchange-traded derivatives like futures and options, and over-the-counter derivatives like large-scale swaps. And Commissioner Benham was worried about so much of this derivative activity leveraging risks, not being well understood in its price discovery function. And so he commissioned a subcommittee that produced a superb report, one of the best we have by any government agency in the United States. So the CFTC since then has actually created, under Acting Commissioner Chairman Benham, a climate risk unit. And to drive home the point, this now is a unit of the CFTC with cross-divisional staff, and they are going to delve deeper into how derivatives either help or endanger us, to the extent that they're a very big component of the financial system, much bigger in dollar terms than anything else. The SEC has launched a project to improve or impose much improved disclosures by companies, that they have to be much more candid about the climate risks that they face. But it's also a very complicated process. There are a number of questions that have to go through. We don't have the right metrics yet, and we don't know which will be effective and which won't, all of which goes back to Jim's statement about how a lot of this goes outside of the regulatory system, fossil fuel industry moving out into the regulatory, away from the reach of the regulators. The Federal Reserve System, as I mentioned, has now begun to acknowledge the scale of the problem and is acting as rejoined an international network of central banks. I think we'll see a lot of action there, but a lot of it will be over a considerable amount of time. And then, as you've probably seen with headlines, the big asset managers have said that they will impose selection standards that relate to climate change. We run into the problem of greenwashing, in which a lot of institutions say they're doing this, but when you dig deeper, you discover that it's words only, or alternatively, companies are simply lying to them about what they're doing. But at the same time, it's being tackled, I think, on a big scale for the first time. The Treasury Secretary announced yesterday that she was going to expect the FSOC, that we'll probably talk a bit more about, to be coordinating this massive action between the big agencies. So I think we've got the attention of government as a whole. The question is, solving these issues is much, much more complicated, but it is a vast difference from just a year ago, where there was simply a resolute refusal by government to address the problem.
Well, thank you, Lawrence. And I did want to ask you about the Financial Stability Oversight Council, but we've gotten several questions that I actually want to get to. So folks have submitted questions directly to me, and some have put them in the open chat. Encourage you to do both. Maybe I'll just tackle the first one on fintech regulation. And since I teach fintech here at the law school, I can take the first stab at that. But first of all, fintech is a very broad topic at this point. So let me just start with cryptocurrency. I think the regulators under Biden are going to really pump the brakes on a lot of the sort of the crypto accommodation that you saw under the Trump administration. The former comptroller of the currency, acting comptroller of the currency, Brian Brooks, for about 8 months at the end of the Trump administration, previously he came from Coinbase, the largest cryptocurrency exchange, served as the acting comptroller of the currency, and then now he just got tapped to lead a new cryptocurrency exchange, Binance. And in that interim period, he basically did everything he could in his position of public trust to roll out the red carpet for the crypto sector and integrate crypto within the national banking system. So I think that's going to come to an end. Of course, it depends a bit on who ends up at the comptroller of the currency. Gary Gensler does have a lot of subject matter expertise when it comes to cryptocurrency. He's taught a course on this at MIT. I think this is giving hope to a lot of cryptocurrency advocates. I would caution them against being too hopeful. I think he's going to take a look at this with a fresh set of eyes. But sort of the holy grail right now, if you will, is a cryptocurrency ETF. That's kind of what the crypto enthusiasts want. I think it's a bad idea for a number of reasons, but I don't think it's going to be a top priority for Gary Gensler. In terms of some other fintech developments on the fintech lending and credit front, again, I think you're going to see a bit of a pullback. The OCC previously had attempted this fintech charter. It had been struck down by a New York district court. I think there's going to be much more respect for the dual banking system and the role of the states in regulating lending activity in particular. So I expect that the fintech charter will lie dormant, and some of this rent the charter activity where national banks are essentially allowing non-bank fintech companies to use their balance sheet to bypass state regulation and state interest rate laws. I think that will get a fresh look as well, and the OCC might change their stance there. So I'll stop there on the fintech space, but I don't think that the Biden regulators are opposed per se. I just think they're going to proceed a little more cautiously. We had another question on Fannie Mae and Freddie Mac, the GSEs, and this was actually something that I did have on my sheet here. So for those of you who don't know, Fannie Mae and Freddie Mac are the mortgage giants. They control the vast majority of the mortgage market in this country. They don't make mortgages, but they buy mortgages from lenders and package them into securities. Ever since the financial crisis, they have been under government conservatorship. And the Trump administration tried and failed or ran out of time to spin them back into private control. And so now the Biden Treasury Department has to think about what they're going to do with the GSE. So I don't know if Lawrence or Sarah, maybe this question is tailored for you. Any thoughts on what might happen to the GSEs, or if not, what do you think should happen to the GSEs, given the just critical role they play in the housing market, and also considering where housing prices are at right now, just the lack of affordability in the housing market.
Sarah?
Sure, I'll start. If that's Campbell Gibson's question, hello, Campbell. Anyway, so Campbell was actually quite instrumental in helping figure out this challenge. This is not a new problem. This is really a holdover from the financial crisis where, as Lee described, Fannie and Freddie were put into conservatorship. It's really not a sustainable solution. So there is going to need to be a fix. The last 4 years, the Treasury Department attempted to do something, but even before that, there was quite a bit of effort to figure out how Fannie and Freddie would get out of the conservatorship and move back into their traditional roles or evolved roles. So that was another set of questions: is what should Fannie and Freddie look like in the future? Should they actually be put back into the same discrete categories that they existed in pre-financial crisis? And of course, now we're so many years out of this from the date of the financial crisis that it's really worth a fresh look. And I think there will have to be that look. I just want to say that it's not a new challenge. I mean, this has been attempted. It's been attempted with bipartisan legislation which isn't to say it can't be done. I'm just saying it's going to take some fresh energy here to tackle this yet again.
Thank you, sir. Go ahead, Lawrence.
You're right, Sarah, about how old this problem is. It's more than 20 years old. It's been going on for a long time because it goes to the heart of national housing policy, over which I think we have a deep ideological divide. And we have a terrible record by these Fannie Mae, Freddie Mac, Ginnie Mae, which insures these instruments, of losses and in some cases even corruption, bankruptcy, which is why two of them are in conservatorship, and disputes about whether it was when the agencies were all government owned or essentially quasi-government owned, as it was called, or when it was private industry that got involved. So, sadly, what's happening is most politicians say that's radioactive, we're not touching it. But as Sarah says, the problem isn't going away. And we know, any of us who've ever bought houses, especially for the first time, how dependent we are on the underwriting of those mortgages by Fannie Mae and Freddie Mac. We simply couldn't afford to buy them otherwise because banks won't take the risk.
One thing I'll just add to Lawrence's elaboration on this question is, we could imagine a reinvigorated role for Fannie and Freddie consistent with some of the climate challenges, right? So as Lee points out, the function of Fannie and Freddie really are to buy up mortgages, to set the underwriting standards for the purchase of those mortgages. And at the same time, remember, we are dealing with a need for a transition to a new economy, to one that is less carbon and fuel based and based now on alternatives and different forms of energy. And yet energy, we all have many of us have homes, and these homes are going to require certain types of fixes in order to meet a sort of the physical risk dimension of climate change. And so I'm wondering whether this challenge, which, as Lawrence says, has been with us for a while, needs to be or could be infused really with a new set of imperatives relating to climate, and whether that might be the way we break the logjam, so to speak, on an old problem by really infusing it with one now that we know has renewed momentum.
Yeah, that's great. Americans tend to treat the 30-year fixed rate mortgage as a birthright, which is one of the reasons why I think we're only one of 2 countries in the world where that's available. So very contentious topic for sure. Encourage everyone to keep submitting their questions. Another question that was sent directly to me, and this will probably be for Jim or Elisabeth. The viewer wants to know, what would Robinhood going public mean for the regulation of retail traders and retail trading platforms? Jim, Elisabeth, any thoughts on that, or just Robinhood's IPO in general? I don't know if they filed an S1 yet. I don't think so.
The only thing I could think of, I'm curious what Elisabeth's view is of this, would be that if going public, it would obviously expose itself a little bit more to disclosure rules that are doing right now, but only at the margins, I believe. But that may bring about some pressure about the ethics of their practices. The other thing that's going to happen is that we're going to find out in a collection of disclosures just how many enforcement actions they have been the subject of, quite frankly. It's a very questionable enterprise. And then their lawyers are going to have a hell of a time disclosing the risk factors, because there's so many risks associated with their, as I understand it, and I understand their business plan, there's so many risks associated with that practice that are regulatory. So it may, going public, I would think would make it more responsible as a business entity. And it may just be that for that reason that they'll never want to go public, because their whole business plan is based upon being irresponsible. Okay.
Elisabeth, anything to add?
No, I agree with Jim. I think with Robinhood, you see one example of many of Silicon Valley meets Wall Street. And Silicon Valley is kind of taking the lead right now in fintech and lots of financial services. And these are folks whose viewpoint is you solve an operational problem and you focus on the product. Whereas Wall Street, we might think of them as totally lawless, but in fact, they're very comfortable and used to regulation, and Silicon Valley is not. And so that poses a really interesting challenge for this big move in financial services, which is towards much more focus on software, much more focus on fintech, that I think is going to come to a head because these are industries that are not used to a lot of regulation.
Yeah, as I tell my fintech students, the grow fast and break things mentality doesn't work well in financial services.
Or maybe it does from their perspective. We'll see.
That's true. We will see. Didn't work out so well for Ripple. So another question. So I don't have any more audience questions, but this will allow me to ask a question that we were actually talking on before we went live, which is the Libor transition. And so I don't know who wants to take this. Maybe Lawrence, since you teach derivatives. Of course, one of the major derivatives market is interest rate derivatives, and Libor underpins much of that market, as well as other financial products. So maybe just remind the listeners, first of all, what Libor is, what went wrong with it, so why do we need to move away from it, and sort of what's at stake right now in finding a replacement for Libor?
Sure. Libor stands for the London Interbank Offered Rate, and it was a system started in London and then was used around the world along with some other indicators. Libor is a reference rate, and it's many different rates relating to interest, varying according to length of time of the loans and so on. And it's also a predictive rate. That means that every morning in London, sponsored by the British Bankers Association, representatives from banks and interbank traders would gather together, and they would say what they thought their bank would charge for a loan a couple of hours later. It was very popular, not only among the banks themselves, but also by borrowers, because it opened up the possibility of variable rate mortgages at lower rates than fixed rates. So, for example, if you had a mortgage with a Libor plus 2% rate, and interest rates were not too volatile, you could usually finance less expensively, but it would go up and down. All good and well until shortly after the financial crisis in 2008, when some fraudulent activity was exposed, and that blew up the whole concept of Libor. What happened was that some of the interbank representatives and some of the bank representatives, for their own purposes, misrepresented what their banks would actually be charging. You can imagine if you had done a deal and the rate was Libor equals 4% plus 2%, or you were about to do a deal like that, it would be in your interests, if you were dishonest, to try to get that rate predicted at that point. And some of them actually ended up defrauding the system. And there was huge fallout, even among banks, because Barclays Bank, for example, was accused of working in collaboration with the Bank of England to keep Libor rates low in order to deal with the financial crisis as it was impacting London. It was a huge scandal, and it meant that there were winners and losers as a result of those frauds, by definition being bipartisan agreements, everywhere in the world. And they were used in the vast majority of interest rate derivatives, and loan rates were set at those rates as well. So it was a huge problem. Because it was set up by the British Bankers Association, there was deep suspicion about the self-interest of the banks, and it was not well policed. I won't go into the details of how they did police it, but if, the British Bankers Association gave it up and said, take it. And the Intercontinental Exchange in Atlanta, which had rapidly grown as a technology company into one of the biggest complex of exchanges in the world, took it on, did, in my view, a fairly good job at trying to structure it in a way that would eliminate a lot of the opportunities for fraud. But because it was considered to be so exposed to fraud, the pursuit began, starting with the regulators, to find something else in its place. Now, think about the options. One of the most reliable options is the historical rate. What was money lent the day before, for example? And that's what we've settled on as an alternative, which is the secure overnight finance rate in the United States, which the Fed reports. The complication is that many of these instruments are very long-term instruments. So, you may have a 10, 15, 20-year mortgage, for example, or it may be a swap deal, a derivatives deal. And so you have to disentangle those or keep running LIBOR for a long time. So the first thing that regulators did was just keep running LIBOR for a long time, but now they are trying to bring it to an end. And if you tell somebody who's got a deal at one particular interest rate that they have to change that interest rate, they're obviously going to have problems with it. So we're in the middle of that tangle, but the regulators have said we have to get off LIBOR completely by the end of, I think it's 2022.
And Lawrence, the last question it comes from Charles Thompson, who wants to know if you anticipate any successful constitutional challenges to New York State's recently enacted law that mandates, I don't know all the details, but it mandates a fallback rate in LIBOR-related contracts, is my understanding. I don't know if any of you had a chance to take a look at that.
I mean, I know about it, but and can't claim expertise, because what you would have to do is look at exactly how it's being mandated. But to be candid, I wouldn't be surprised if whoever's out of the money in these deals is not going to take it lying down. I'm not a constitutional lawyer, so I don't know whether that's likely to happen, but we've seen lots of litigation in various facets of financial instruments coming out of the financial crisis. And if there's enough money at stake, I would not be at all surprised if there would be a challenge. I just don't have the expertise to know whether it was likely to win.
All right, well, we'll end on everyone's favorite topic, LIBOR. Lawrence, Sarah, Jim, Elizabeth, can't thank you enough for joining us today. Everyone who attended, thank you. Stay safe, and you'll be able to check this out on YouTube pretty soon. So make sure you check out the Global Financial Market Center's website. Thanks, everyone.
Yeah.